Hi, this is Paul from globaltradingsoftware.com, and this is a breakout trading tutorial for futures trading, for day trading. In particular, I'm going to be using the xBrat range breakout, but also combining the manager there to look at the no-brainer type trades, but also then the ones that need to be careful. And there's two instances of this from last week. Thursday was the no-brainer. Friday, a little bit more difficult. So there's going to a few things. We're going to look at the London opening range, the London Stock Exchange, and also the New York Stock Exchange open, because they're the ones really that we are interested in. Those ranges on the 15-minute, that first 15 minutes is pretty volatile and usually gives us the direction. And there's a few things we can use to help that. So let's talk about Thursday first. This was the no-brainer. So in London, we've just look at the manager here coming up green. The ribbon is green, starts to change over, and as London starts to come back down, we are just turning red just after there. Now, the one thing we look for with the range breakout is that the range itself is given a bias. The software gives it a bias. You can see yellow here is neutral, green is bullish, and red is bearish. So when that range is defined, and in this case it's coloured in red, we only look for the shorts. The shorts are the ones that we look for well, there's two different types of ways to look at this. With this London, and we've only just got this the manager ribbon turning from green to red, we'd only look for a specific amount of ticks. So 30, 40, 50 tick scalp, get out, round about here. Okay, now coming into the New York open, this ribbon, although it touches, never goes to green. So we're going into this ribbon highly sort of bearish, if you like. That's confirmed with that first 15-minute candle. We have the actual range itself, the bias is bearish for the range, so you go short and you go all the way down. In this case, because the ribbon of the manager, and these are two separate indicators. The manager is to manage the trades, but also I'm using it to give me an indication of which type of management I need for the range breakout. And then there's the range breakout itself, which defines the range, defines the bias, and you just go short or long depending on the bias. So in this case here, we're already going into the New York Stock Exchange open with this ribbon already red. So I'm not going to do that 50 tick scalp like I did with London, because London we just, we're still green going into there, it's just changed, but this one, the momentum is bearish. So I'm going to use the manager then to trade this, to keep this going. As this pulls back here, the manager has these little blue dots underneath. That's lower than average volume pullback. Don't panic at this stage. It comes back down again. We're getting higher than average volume, big red candle here. We've got a rejection candle here, higher than average volume, but then it's formed a big green candle with higher than average volume. That's the time to get out just before the session closed there. Great trade. So that's the no-brainer. We've got two different ways to manage this. Again, just to repeat, this is very important. When we've got this changeover from on the ribbon from the manager from green to red happening just after or in and around that open, we look for the scalp. So we only go, with ES or indexes, we look for a 30, 40, 50 tick scalp and we get out. But if we're going into the opening range session, the open of the New York, for example, and we're already with this ribbon already red, we're going to flip. We're not going to look for the scalp. We're going to look to use the manager, this ribbon getting red and getting wider and wider all the way down here, to manage the trade, to maximize the profits. Now we come to Friday, it's not so easy. So we've got the London open. We again look at this ribbon, green, red, there's total indecision leading into London. On the previous day we were bullish and then we were bearish. Here during the Asian session we were green, red, green, and then we're green going into the London session. Here on the ribbon we're only going to take a quick scalp again for that short. So the London opens, the range is defined, the range is given a bias of red, go short, take the quick scalp, get out. Okay, there are other opportunities when it comes back down through. Again, you see it goes up. We don't take any longs because the bias is yellow at this point. We come back down, we test. Now the bias turns red. There's another quick scalp there again. Again, we're not really going to be looking for longer term movements here because of the manager telling us it's just real big indecision. Comes back up again. Look at this, range turns red again. Another scalping opportunity. Fantastic. We're coming back up through. The bias turns green. Quick scalping opportunity to the long. With bias turns red again. Quick scalping opportunity to the short. Now we get to the New York Stock Exchange open, and this range is 264 ticks, more than double the range from the previous day. So this all of a sudden becomes a whole different animal, because this one is less than 100 ticks. This is a good range, it's a no-brainer. This one you've got to be careful. Again, the ribbon on the manager is telling you to be very, very careful here. We're just not really getting any real direction. So if you are going to change this, and I would not trade this if it's over, say, 150 ticks, this range. If I did, it would be micros, and I would only go for that 50 tick scalp, which worked quite well in this case. It comes back up through, test the London session. There was the bias within the opening range for London is green. You can take that 50 tick scalp again at that point, but you've got to be careful. Comes back into the range here, comes back out, goes green again, quick 50 tick scalp again. So this is a scalping day, where the other one was more of let it run. It was a runner and you use the manager. We come back down, go towards the end of the session. Even though it goes red, we're not going to be interested in trading that, because this is such a big range. So two total opposites there, and I think it's a really good example of how to use this range breakout with the manager. It's a very, very important combination there, not just to manage the trades, but also give you an indication on how you're going to manage the trades going into the trade. So whether it's going to be a scalping opportunity, or indeed like this one, which I call a no-brainer, is we're red already in the ribbon. It's coming into the New York session and it's red and it's going down. The range is pretty tight really for ES, and it just goes. And use the ribbon on the manager or the dots for the higher or lower than average volume to manage that trade, to maximize the profits. I mean, this was one of those 600-700 tick plus type moves. This one, you probably, with those little scalps there, you probably got about 200 ticks during that day, but a lot harder work. But you've got to be aware and use that manager combined with the range breakout to get those fantastic trading opportunities on a daily basis. Hopefully that helps. Speak to you all really soon.